Welcome to Multifamily Insights. I'm your host, John Kasman, and I want to thank you for joining us for another great episode. If you're enjoying this show and getting some great value, do me a favor and leave us a rating and review. I want an honest review. I want to hear what you love about the show, but also anything that can make it work harder for your investing goals. And if you have not done so already, be sure to hit that subscribe button so you don't miss an episode. We got a great one today. We're going to be talking to Litan Yahav. Litan Yahav is an ex-naval officer, exited tech founder, LP investor in real estate and private equity. He's an angel investor, and he's got a passion for passive income and wealth creation. He is also the co-founder of Vyzer. Wes, welcome to the show, Litan Yahav.
John, I'm super excited to be here. You're awesome.
I love it, man. You see, I had to pause and hesitate to get that last name a second time, man, but we got it together here. Hey, Litan, we've been talking for a little bit, and I'm excited to have you on this show. I went over your bio at a very, very high level. Why don't you take 2 minutes and fill in the gaps?
Sure. Yeah. So I'll go back a little. So I'm 40 years old. I'm married. I have 3 kids. I was born in the States. Currently live in Israel, far, far away. Was in the Navy for 6 years, like you said. And then after that, I went to school. Studied law and business and founded my last startup about 12 years ago. Very weird industry, diamond and jewelry. We did 3D imagery for diamonds, helping people trade their diamonds around the world. It went well. Scaled it to 250 employees, basically photographing all the diamonds in the world. It's the standard today for diamond photography. And we left the company back in 2018 after we sold it, and me and my co-founder. And the acquisition was back in 2015. So basically for the past 7 years since the acquisition, we've been managing our money. And we sort of, the exit was great. We didn't make tens of millions of dollars in the exit, but we made enough money, take a minute, invest it, travel a bit, iterate different business ideas. And over the time began to invest it on our own. And I mean, you can imagine after you sell a company, there's a bunch of PR, people start to sort of reach out. Hey, why don't we manage your money? Why don't you give you this, give you that? And we just said, screw that. Let's just do it on our own. And we, in Israel, sort of everyone knows a guy and everyone does real estate. And so we said, yeah, we know some friends or friends of friends. And we just started to research like investing passively in real estate in the US, in Europe. And sort of that's sort of what got me into real estate investing. Over the past 7 years, we've done about 30 different deals, all passive, all sort of with operators we've met over the years, and we've sort of learned to trust them, and it's been going well. I don't know what's going to happen now in this environment, but until now, it's been going very well. And so that's sort of our endpoint into real estate investing. Learned a lot of lessons over the past 7 years, investing as an LP in these types of deals, questions to ask, things to do and not to do. But one of the things we've encountered like 2 years ago, sort of, and I'm going to just say these are good problems to have, right? But we started to reach a situation where our spreadsheets became insane, and multiple bank accounts and cash coming in and going out, capital calls and distributions, just like problems and headache. And we decided to automate that process for ourselves, and friends wanted it as well. We said, wait, there might be a business here. And we ended up building a startup. So that's sort of Vyzer and segue into that. And we can talk about that or any other aspect you'd like to talk about.
Well, I love it, man. Listen, let's break it down first, right? Just to recap it, you said you kind of created a very interesting business, 3D imagery of diamonds, built that up to 250 employees, sold that company in 2015, had a nice windfall, maybe not tens and tens of millions, but enough money to step back, invest, figure out what you want to do next. And you focused on real estate investing, particularly passive real estate investing in the US. And if my notes are right, you said you did about 30 different groups, 30 different deals over the last 7 years, and had this challenge where now you got a lot of investments all over the place, and just managing those investments and keeping track of what was going on became a challenge. And that led you to launch Vyzer. I want to kind of go back a little bit and digest some of this, right? So you mentioned, launching this company with your partner, and kind of launching it to, be this big company that was now the industry standard. What led you down that pathway? Because you're right, that is kind of an interesting area to get into. I mean, did you have a background in the diamond industry, or how did you end up going down that path in the first place?
So I think our biggest advantage building that business was that we did not have any background in the diamond industry. So it's that, like, when you think about these archaic, I'll be cautious and say this archaic industry, but it is an archaic industry. Like, when you think about it, these industries, they're so old fashioned that they're so used to their own ways of doing business. It's very hard for people within the industry to innovate to such an extreme level of changing the way things are done, right? So if you think about the diamond industry 10 years ago or 15, 20 years ago, people manufactured diamonds in one location around the world. They traded to a different location and then to a different location. And then at the end, it reaches a jewelry store and it's sold to a consumer. And that whole trade was super inefficient. And the reason we even got to it is because Tomer, my co-founder, and myself, we were together in college. And on our last year of college, we were in this program funded by Sam Zell, this Zell entrepreneurship program. And at the program, you're sort of tasked with finding an idea to run on and build. And so you start to look for like, all right, what problems are there in the world that are worth solving and that we can solve? And during that process, we stumbled upon the diamond industry and sort of walked. We were introduced by a friend to sort of the way the industry works and walked around the Diamond Exchange building, and we were just blown away by the way things work and said, damn, how is it possible that in the 21st century, things still operate so old fashioned with so little tech? Let's see what we can do. And so that's what brought us into the industry. And thinking that we can change it only what enable that is the fact that we were outside and not in it.
Oh man, it's great insight right there. And then that really led you to building this company and having the success. Now, that program, were you more in business kind of entrepreneurship, or was it more manufacturing or engineering? Like, what's kind of your background there?
Yeah, so my background is business. I studied law and business. My co-founder studied business. Both of us are like military guys. I was in the Navy for 6 years. He was Air Force Special Forces for 6 years. Like, we do not have a technical background, but we are very technical people. And we had a co-founder. We brought on a third co-founder who was our like chief technological officer, or CTO. And together we built this company, which was very much tech oriented, but a lot of business and operations.
I love it, man. I love it. I love it.
Yeah, no. So the operation here. So the cool thing about this business is that there was a lot of technology, but we never sold machines. So we developed this machinery or this hardware to use for ourselves, but to use it to offer service for this industry. And so we opened we opened locations in the diamond exchanges around the world. And the cool thing is they're very concentrated. So like 5 core diamond exchanges. Like there's New York, there's Antwerp in Belgium, there's Ramat Gan in Israel, there's Mumbai in India, and there's Hong Kong. Those are the 5 diamond like centers of the world. And so that's where the trade happens. And so we opened offices there, and then it was basically a service. So the operation side was really our side of the things, me and my co-founder Tomer, and the technological side was the CTO we brought on board. So that's my background there. And yeah.
I love it, man. Well, let's fast forward in the story, right? So you go from there to, selling a company, having these funds, and you're trying to figure out what kind of investments you want to make. You land on kind of investing in US real estate, even though you live in Israel. So how do you vet sponsors? I mean, what's your process there on those first few deals? Are you just Googling stuff? Do you fly into the country? Talk to me about your process.
Yeah. So my methodology. So our process is that we do not know real estate, right? I do not know real estate. I'm never going to be a real estate professional. That's not my job, and it's not my aspiration to be one, right? So what we do is we find people we can trust. That's like our mission. Find those people we can trust. We can vet them. The fundamental aspect for us is that they won't screw us over and that they have some experience in this industry. Specifically for us, it was people that weren't too big. We wanted to know the owners. We wanted to be a lean operation that were hungry to find deals and not sort of this sort of manufacturing house of deal flow. For us, wasn't what we were looking for. And and that's sort of like, and we didn't know that from the get-go, right? From the get-go, we had friends. And the cool thing in Israel is that everyone here does real estate or broad passive. And so it's like everyone knows a guy here that does real estate in the US or in Europe. And we met with one and another, and these are good friends of ours or good friends of good friends of ours. And we just have one of the people we met here in Israel who does syndications in the US. We just took a chance with them, just like total gut feeling, knowing he's not going to screw us over, and that's fine. And he's been doing this for a few years. Let's gamble. And so I don't remember if the first investment was like 50,000, both of us together, because me and my co-founder do everything together, or was 50 each of us, 100, but we just did that. Actually, our first deals weren't even that. So we bought two single family homes in Ohio through a different guy. We never saw the properties. We trusted him. It was fine. It was a really cheap deal. It was like $60,000 single family homes, but it was the worst deals we ever did in our life. And we decided from that point on, we're not doing single doors anymore because we want diversification. We want passiveness. We're only doing syndications. And so then from then on, all of our deals were only with syndicators, operators. You know what? Even I'll emphasize that we started with syndicators and sponsors. And then we found out that we're sort of not investing in the operator, but we're investing in a fundraiser for the operator.
Mm.
And we already had enough access to reach the operator. And so we decided to invest directly in the operators that we know and we can vet. And we found more people in Israel that do the same thing in the States. And so that's how we started. And we learned throughout the process what questions to ask and who are the people that we want to invest with and who we don't want to invest with based on those questions and experience.
I love it. So let's go back to, you said you've been doing this for 7 years now. If you could go back to, 2015, 2016 and talk to yourself at that point, what are some lessons learned with vetting operators or figuring out which deals you want to do that you would share with that person?
Yeah, that's a great question. I have to think about that for a second. I'd say, first of all, I tell myself, do not invest personally in those single family deals. It's a mistake. So I would not do that. The second part would be um, sort of, so the question, I don't know exactly if it's like things I would do or I wouldn't do. I think questions I'd ask. So, for example, I'd want to know if the person I'm investing with is the operator, the one that's sourcing the deal, that's financing the deal, that's raising the money for the deal. And that's the person that I should vet and not the fundraiser for the deal for me. So, for me, because when you vet the fundraiser, you need to also trust him that they're vetting the operator, and they might do a good deal and they might not do a good deal. And so, preference for me is to vet the operator. In addition to that, sort of for me down the road, like the operators I love most to invest with are people that have that sort of like, they're like full turnkey. So they're one stop shop for everything. They're the operator, the property manager, the fundraiser, like everything in one. I feel that those have been my best deals today. It might have been luck, it might not, but that's like one of the things that sort of we look more for. I'm not saying like, so we've done 30 deals with 10 different operators over the years. And we don't do it like those 10 operators we don't continue with all of them. Some of them we do, and some of them, most of them we still do, and a few we don't. And the third question I think I'd ask, and this I still ask every operator I speak with, what happens when there's a refinance event? Because it might sound very straightforward. Just to clarify what a refinance event means, and you might be able to clarify this better than me, but it's like when you invest in these multifamily value add type deals, usually those types of the deals are that have a refinance component, means that when you go in, when they buy the property, they're going to take a loan from the bank and they're going to finance it from LP investors like me. And then as they sort of value add the property, the value of the property goes up, rates might go down, and then they refinance, meaning they add another loan from the bank, and then they pay out the LP investors so that we can take cash back out and still have equity in the game. Does that sound like a good explanation?
Absolutely. Absolutely.
And so when that happens, and I'm gonna go back a second. So when you invest like 50K or 100K in these deals, there's usually like an annual cash distribution, like that's distributed every quarter, right? And usually that's based on the capital you have in the deal. And then there's the upside at the end if there's an exit event and all that. So when there's a refinance event, right, you get money back out, you still have capital in, or you don't have any capital at all in. So then the question comes as to, well, if I invested 100 and you gave me 70,000 back after a year in refi, and before I got 8% on the 100, what happens now to my 8%? Is it on the 30? Is it on some sort of like waterfall that any profit above that is a split? Like what happens? And I've seen so many different types of ways people and GPs structure this. I'm not saying which is good and which is bad. It's like one of those things that you have to put everything in front of you to understand what's going to happen and not be surprised. And so that's a question I always ask now. What happens in that type of event? And you'd be surprised about how many sponsors and operators don't know how to answer the question. Like they have to go and check.
Yeah, yeah. I think
So
that's a great question for a few different reasons, right? And one is what you were just getting at. Do they even know themselves? Do they understand what happens? And I think part of it is just understanding the deal structure, but also the intent, right? And like part of it is like, is the intent to get it back as much equity as possible for the general partnership or sponsorship team, or is the intent to keep things fairly simplistic and say, hey man, it's just your equity is your equity. We're going to return some money, but you keep that equity. Maybe you don't get the pref return now since you got some of that money back, but you still retain that same amount of equity in the deal. So just understanding some of those things, I think, is important, and that's probably one of those questions that helps you understand the level of clarity on other aspects. So I used to be in the marketing world, and when we did events, you would have writers for celebrities or entertainers, and a lot of those writers just had a bunch of crazy stuff in there. And there's a great story about I forget the group, but there's a band that used to ask for only green M&Ms or to not have any green M&Ms. And it wasn't that they just loved green M&Ms or hate green M&Ms. It was like I would just check for that one thing. And if that was done, then I will assume that every piece of the writer is actually read and you actually, executed the rest of it. But I know if you miss that, then the likelihood is that you miss something else too. So that could be
Right.
one of those things that, an operating agreement is, 50 pages. I mean, some of these PPMs are 100 plus pages. So I know everyone can't read and fully understand every single word or language in there. Hopefully you can, you're taking the time to understand it, but really asking the right questions can at least help you understand some of these things a little bit better. Thank you for clarifying that. Just to kind of go back to your point there, asking them what happens, in a refi event. And you mentioned that you kind of have, you work with 10 different operators right now. If you look at the operators that either you, and I'm not trying to name names, but just like, are there things you've learned with different groups that you say, hey, we no longer look for these kind of operators, or this is something that we've changed in our criteria as we move forward?
Yeah, so this is sort of counterintuitive, I think, for most people. And I've also met people that totally disagree with the way we see it. But,
Mm-hmm.
and again, I don't think this is right or wrong. It's just the way we see things. When an operator becomes too big, meaning there are too many LPs in their pipeline, that usually means they have a very big operation to maintain those LPs. That means they have to have really, really nice offices and very high overhead and a large team to vet deals. And because they have so many LPs, they need to deliver deal flow. And so, like, it becomes, for us, that becomes a risk. Now, it's sort of, it's counterintuitive because the bigger you are as an operator, the more experience you usually have, the more deals you've seen through. And so essentially that means you should be getting better deals because you get the good deals, you have more cash to put on the deal. So you're faster. So anyway, it's counterintuitive. And I assume, again, I don't know how many people would agree or disagree with me, but for us, it's like, I want the people we invest with to be extremely hungry to deliver exceptional deals and performance on the one or two deals they do a year. Um, and I'm willing to take the risk on their experience on that because usually people who do one or two deals a year aren't as experienced as the huge guys that do multiple, like 12, 15, 20 deals a year. And also for me, I think it's a numbers game. Like deals fall, it happens. Like shit happens, and it's okay. Like market changes, stuff happens. Municipalities give hell to many sort of these operators. So things happen, and I think the more deals you do, one of them is going to fall through. It's just a numbers game. And so me as an LP, I don't know to look which one of those deals to go in. So I just prefer to go in with the smaller guys. So that's sort of like one thing that we've learned over the years that works better for us. So we've had operators that have grown to be bigger than we feel comfortable investing with, and we don't invest with them anymore.
Makes a lot of sense. And to your point, it's all perspective, but your perspective is I'd rather place a bet. I'm take your words and put them in different words. But
That's all right.
what I'm hearing you say is I'd rather place the bet on the operator who is almost 100% or truly focused on this one or two deal that they do a year because these are the only deals they're doing a year. So they're going to have way more focus on the operation and execution of those deals than the group that's doing maybe a deal every month because they're doing 12 deals a month. You start to scale, maybe some things get glossed over and there's more of a likelihood that something may be missed or something just goes awry. And again, there's not a right or wrong answer, but that sounds like the perspective that you're taking. Is that fair?
Yeah, exactly.
All right,
I love,
awesome.
I
So
love, I love, I love the way you take what I say and say it so much simpler than I do it. I love it. Thanks, man.
it's my little processor, man. I have to break it down so I understand what we're saying. So with that said, you mentioned that you've done over 30 deals, and we talked about managing these deals can become a challenge for many people. You were doing spreadsheets, it sounds like before, and it's a good problem to have. But how are you managing these deals now, and how did you go from, hey, we've got a lot of deals over here that we're managing to we got to have a better solution and coming up with that?
Yeah, right. So I'll give you sort of the use case that we sort of faced at the beginning. So like, all right, so if you put 50,000 into one of these deals that's supposed to generate 8% cash on cash in 5 years to the exit, it's pretty straightforward, right? You're supposed to get, $1,000 a quarter, and then in 5 years, 75 or 80 or whatever thousand bucks back. That's super simple to track if it's one deal, right? Because you're going to get a quarterly update from this operator saying, all right, this month, this quarter, this was the performance, this is the cash distribution. And then a week or two later, you're going to see the cash in your bank account and you remember what it belongs to. And that's fine. And that's easy. No need to sort of create crazy systems. But once you enter the like 5, 10, 15 deals, you get those quarterly statements. You don't even remember how much you invested, when, what were your expectations. Like, again, good problems to have, right? But you don't remember that type of stuff. And let alone, even if you do, 2 weeks later, you're going to get, like, after the quarter, 2 weeks after the quarter ends, you're going to get money in your bank account. And that'll get sort of like together with everything else that's happening in your bank account. And that's just like one asset class. So there's other things happening in your life, right? If you work, you have a W-2 income. If your wife works, there's cost of living. There's a lot of stuff happening and it's distracting. And then it becomes a job on its own. Like that's because like people with tens or hundreds of millions of dollars hire a family office or like a person full time to do that for them because they don't want to or have the time to do it themselves. So we reached that point a few years ago where the spreadsheets became crazy, multiple bank accounts with cash going in and out, documents coming in, documenting them, tax return. Like it just became a headache. And we used to lose track of stuff. And one year I even forgot to tell our CPA about a deal we did. So like it was stuff that just got out of hand. And so we hired an engineer and said, all right, build me and my co-founder, build us a piece of software that automates the process. Take my spreadsheet. I want to upload it. I want it to translate into data. I want to connect my bank accounts and I want to monitor those transactions automatically. Let me know when something comes in, automatically match it to one of those investments based on different parameters. Let me know how my cash will look moving forward because I'm still in wealth creation mode. I want to make sure my cash is deployed. I want to make sure when I'm ready for cash to come back, I want to be sure I'm ready if there's a capital call, and I want to be cash poor, but I also don't want to be sitting on too much cash. So I want to be able to plan everything. And then while building this platform, like I said, a bunch of friends wanted it as well. And that's sort of what sort of hit us that, hey, there's a bunch of people like us. So that's sort of what brought us to sort of build what we're building at Vyzer.
Yeah, so you talked about managing the cash flow, seeing what's coming in and out of the bank account, lots of action there. Again, good problems to have, but still, you got to report all this stuff, right? You got to go to the government. You're
Exactly.
getting your K1s probably and trying to match up the K1 statements with what you actually have. And that can obviously become a lot of work. So you created Vyzer and you mentioned that you kind of tested this out with a couple of other people that you knew. How did you realize that this was kind of a viable product, especially given kind of your background in the tech space? How did you realize this was a viable product and that you wanted to roll this out to other people?
Yeah, so I mean, at the beginning, we said no one's going to use this. Like we're the only ones in the world that have this
Right.
product. And then we just started to, when people started to reach out to us, and these are just friends of ours around our circles, and they're like, "Wow, I mean, I want this." Now we said, "All right." At some point, we just said, "All right, let's hold on a sec. We have time. Let's start to research the world and understand, all right, what's out there. What are people like us doing?" And we started sort of like interact with people online, like Facebook groups and join these other forums and started also interact with GPs and ask like, what are your LPs doing? Like, what's out there? Like, how are you guys dealing with the problem? And I think we spoke to about 100 or 150 people after a few months. And we reached this conclusion that there are just millions of people like us. Because even looking at the US alone, and we decided to focus on the US, there are like 50,000 GPs in private equity real estate in the US.
Wow.
That's like an insane number. And even
How
the
did you come across
company,
that? That's a Crazy stat. How'd you come across that?
So there's a whole business in the tech world that offers these companies a different type of service. Like it's a top-down service. It's like companies called Juniper Square, Syndication Pro, InvestNext. Like these are companies that offer GPs sort of the LPGP relationship platform. So they help sort of, you're probably familiar with these platforms, right? You
Absolutely.
can you can distribute like PPMs and investment docs to your LPs. You can distribute money, and so they're like 35 companies built to serve GPs. And I'm like, wait, how is there business for 35 companies? And that doesn't make any sense. And so you look at the landscape, and in their data, they're pitching 50,000 of these GPs. Now this can be a GP with 10 LPs, and it can be a GP with 1,000 or 5,000 or 10,000. Like I'm not even talking about the Blackstone and the KKRs and Apollos of the world, right? I'm talking about all the rest. And that's where most people invest. Most people do not invest in the tier one funds. So that's sort of when you look at the market landscape, you see, oh, wait, hold on. If there are 50,000 of these GPs, there have to be more people than us that invest in them, right? And so that's sort of, and we said, all right, let's say an average 100 LPs per GP. So because there are people with thousands and there are people with a few handfuls, so that's a 5 million people from a sort of a bottom up approach. I mean, accredited investors in the U.S., well, at least until a few months ago, before the crash, there were about 21 million accredited investors in the U.S., like millionaires in the U.S.
Yeah,
So
it's great to hear. It's great to hear. So you realize that there are 50,000 GPs. Bottom line is there's a big audience of people who are looking for services like this. And that's when you kind of rolled it out. So we kind of talked a little bit around it, but what exactly is Visor? And like, what exactly does it do?
yeah, that's a great question. So um, when you think about it, if like I said, if I had $100 million, I'd have a family office. I'd have someone that I can just forward everything to. They'd have access to all my bank accounts. They'd monitor my cash flow, my transactions. They let me know if something's in play or out of play, in the money or out of the money. They're that place that sort of serves as my financial truth, right? And so essentially what we're trying to build at Vyzer is a virtual family office for the rest of us. So for those people that have a complex portfolio but don't have enough money to make sense to pay or build a family office. And so essentially that's what we're trying to build, that virtual family office. And what that, if I take that down sort of to ground level, because it doesn't mean much to most people, it's sort of, it's that place where you throw in any financial document. You get an email from an operator from a fund, you just forward it to Vyzer. You upload it into our magic box. It's a place we've built that you just throw any document into. Well, you link in all the bank accounts, and then we'll identify transactions to automatically link them to specific investments so that we monitor performance. And because we have all your information in a platform, we can then project your cash flow and let you know where you're going to be a year, 2 years, 3 years, 10 years from now. And then obviously all your documents are in one place. So you want to file your taxes, you click a button and it goes to your CPA. And so there's a lot of stuff, and there's a lot more we're building out. Like we're at the stage where we're bringing enough value where we already last week we launched and starting to charge for it, a flat fee, but we're adding on a bunch more features and value that we think is super necessary in this industry, and we're feeling it from our beta users and members.
How long has Visor been available to the public?
So we founded the company a year and a half ago and launched a closed beta version of it 6 months ago, and opened the beta up 2 months ago so anyone can sign up for the beta. And we went live last week.
Last week. So, guys, this is pretty much fresh off the press here as far
Exactly.
as Visor and the platform. So, definitely want to make sure you check this thing out, see if it could help you with your investing goals and just tracking your stuff. If you want to learn more, go to Vyzer.co, Vyzer.co, and we will make sure we link to that in our show notes. I want to make sure we ask one more question if we can. You talked a little bit about or alluded to kind of the changing tailwinds in the marketplace. As a limited partner invested in multiple deals, what impact has that had on your investing strategies or kind of your outlook moving forward?
Yeah. So, I mean, obviously there's a lot of uncertainty, and I really think timing the market is something you should never do. But when you look at current market conditions, especially I think interest rates, that's like for me, and I'm not a real estate professional, just to put that into context, just like from my unprofessional opinion, the interest rates are high and they're going to get higher from my humble opinion. And so that'll affect two aspects of investing in this type of asset class. I think one is I think refinances will not happen as often as they did last year, because in order for that to happen, there needs to be better terms in the market for the operator to take out money. So I think refis are something that I will not expect from deals. Second, because the terms are so bad now in terms of rates, the profits have to go down as well. So if I'm speaking with an operator and they're telling me the same exact terms as they would a year ago, then I think I'd question it. I'm not saying it's not possible, like everything's possible, because you're probably going to see like real estate prices going down now because buying them is more difficult. Again, it's like this cycle that I don't think I'm the only one who's like it's totally like out there. Everyone's talking about it, but so those are two aspects. One, refi. Two, I'd second guess deals that have the same expectations as they did a year ago.
Makes a lot of sense. You would expect that, the pressure on interest rates to, expand cap rates, and maybe refinancing is not an option, and maybe the returns need to be moderated a little bit more. Are there other things you're looking to do with your money instead of investing in real estate, or what's the opportunity cost here?
Right. So I sort of am pessimistic about the market. I think that inflation will continue to rise, and I think there will not be any other choice but to increase interest rates even more. And there's a lot of cynicism in the market now. But if you think about interest rates going up, that means that the zero risk interest rate on your savings is basically going to be very, very high. And so I think in an environment where we can reach very high zero risk interest rates, it'll be very hard to justify investing anywhere else. Like let's say I'm going to exaggerate right now. So now APYs are usually like around the 2.5%. I'd say in banks. I think they're going to reach they can reach 7-8%. Like you look in sort of third world countries like 14-15%. And when you think of those types of environments, it's like, why would anyone not invest just and put the money in the savings account that's daily liquid at zero risk and make 14%? I'm not saying that's going to be the situation in the US, but I'm saying it can reach like high levels, and then the marginal risk or the marginal sort of profit on the marginal risk won't make any sense. Like any investment that's not there will be substantially higher risk, but also a little bit better returns. Again, I'm not a financial expert, and I might be totally wrong, but this is sort of things I'm thinking about. It doesn't mean I'm going to stop investing in real estate. It just means I'm going to be more minded as well to the zero risk interest rate.
Yep. So you're just paying attention to the APY, which is essentially savings account. So, if you can put your money in a savings account and get a 7 or 8% return, sounds like a great place to park your money. And, that's what, 10, 11 years ago. That's exactly what I was doing, right? I was putting my money in an account and getting 6-7%. And it was a great way to be, but we haven't seen that in quite some time. Right. With that said, we're going to move on to our round of insights. Give me a failure or an apparent failure that sets you up for later success.
Whoa. I spoke about this, and this is it's already like fresh in my mind. But those 2 single family homes we did, that was the biggest failure we did investing wise. We lost money in those deals, and that sort of led us to not invest in that asset class again. For us, I think that if you can't diversify your portfolio enough, and you can't actively deal with managing it, then I wouldn't do it. That's sort of that insight.
All right. Give me an app or digital resource you use for your business.
Notion. Notion? Notion is an amazing app for sort of like creating a knowledge base and sharing information and sort of clearing up notes and just have that place. It's super intuitive and simple to do a lot of stuff.
It's great. Well, check out Notion. Give me a book that you've recommended or gifted the most in the last year.
So there's only one book I finished audible, listening to it, and immediately began to listen to it again. It's Never Split the Difference by Chris Voss. It's an amazing book on negotiation, and I can't recommend it more.
What's a daily habit that helps you stay focused on your goals?
I try to do 100 push-ups a day. That's like every day, 100 push-ups. That's what I try to do, and that sort of helps focus, I guess.
All right, I love it. Give me your number one insight for investing.
Generate passive income. That's sort of the objective should be passive income, and wealth should be the means to generate it, not the other way around.
Great tips there. All right, let's lighten the mood. So I know you travel a lot, but still based in Israel. Give me your favorite place to grab a bite to eat, and I'll let you pick the location.
Whoa. Get a bite to eat. So, I don't know, the hard, she got me on the spot there. Listen, I mean, I love Mexican food. And there's this great place in Tel Aviv just to get really good tacos. So it's called Mescal, but I mean, that's sort of like not in anyone's path, I guess. But if you're ever in Israel, hit me up and I'll connect you with some really good places.
I love it. I love it. Well, listen, you gave us a lot of great insights, and I appreciate you sharing a little bit about your journey going from kind of the Naval Academy and working with so many different individuals to launching your diamond company and kind of this 3D imagery, all the way to investing those funds, the earnings you made from selling that firm, and then ultimately becoming a passive investor and building Vyzer.co. Again, for our listeners, if you want to learn more about what Litan is talking about, you can go to Vyzer, VYZER.co, and you'll be one of the first people who have a chance to access this, since it was just released to the public over the last week. So this is really great timing and definitely a platform that you should check out. And again, if you have any questions or you want to connect with him, you can check him on his LinkedIn page. We'll make sure we put a link to his LinkedIn bio on there as well. And I just want to thank you again for making the time to talk to us today and being a guest here on Multifamily Insights. Litan, I hope you have a great day. We look forward to staying in touch and talking to you soon.
John, this was awesome. Thank you so much.